Welcome to Module 26, Securities and Insurance Activities. These are activities that are predominantly occurring outside the actual bank, but as a result of the Gramm-Leach-Bliley Act enacted in 1999, are now permitted within the holding company structure and has really changed sort of the nature and the size of bank holding companies. So, as a bit of a refresher, in 1933, the Glass-Steagall Act was enacted. As you might know, this was after the Great Depression, and there was the concern of mixing banking and investment banking. And so it forbids national banks from underwriting securities other than certain government securities that are permitted under 24/7. This continues today. So banks cannot, in general, underwrite securities. It also prohibits a company engaged in issuing and underwriting securities from receiving deposits. Receiving deposits is what makes a bank, so it basically forbids investment firms from engaging in banking and banks from engaging in investment activities, and those continue today. But what was repealed in 1999 was the prohibition on the affiliation of banks and firms principally engaged in the business of securities underwriting. And the other was the interlocking of directors. That may not be as big of a deal, but it does address an issue, which is finding appropriate people to work in both the investment banking field and the banking field. So the first case that we looked at really just kind of highlights what we see happening in these big bank holding companies. So we see a lot of the banking activities here, the credit cards, deposit taking, CDs, trust activities, lending. And this was actually a challenge by a non-bank to a kind of a name dispute. But what's kind of interesting for our purposes is where we see the discussion of Citicorp acquiring an insurance company, because this actually was taking place in 1998. And if you think about it, this is prior to 1999 when the Gramm-Leach-Bliley Act was enacted. And so Citicorp actually acquired an insurance company before it was permitted. Now, obviously, they had to go through approval. And as you might recall, when a bank acquires a company that engages activities that are not permitted under the Bank Holding Company Act, they have 3 to 5 years to divest. But Gramm-Leach-Bliley was sort of being negotiated, and everyone was confident that it was going to be enacted. So Citibank took the bold move of actually acquiring an insurance company before it was permitted to have that under its holding company structure. Now, this was really quite controversial, particularly because the insurance industry was rather opposed to allowing bank holding companies to own insurance companies and engage in insurance business, largely because insurance is a state regulated, and at this time in 1998, 1999, it was a personal business where people oftentimes had a broker and they went to an office, and they were really worried, the insurance industry that is, that if banks could offer insurance or their affiliates could offer it, that no one would go to their insurance agent. What's quite interesting is that if you think about it, Citicorp does not actually offer insurance. And that is because it really didn't turn out to be as profitable as they expected. And they sold off the insurance company that they purchased in a surprisingly sort of short amount of time. So it illustrates that sometimes the biggest concern with a change in the law is not really the thing that ever happens. It really hasn't come to be that everyone gets their insurance from an affiliate of their bank. But it is possible now because of this whole concept of a financial holding company, which, as we discussed, it is a bank holding company that meets certain requirements. And this was the type of special holding company created in the Gramm-Leach-Bliley Act. And this may have a little bit more meaning now that we've discussed some of these other areas. So the depository institution, the bank, has to be well capitalized. And we know that this is part of the examination and supervision process, that the bank is given a capital category. They're also given a management category, so they have to be well managed. And again, it's the depository institutions. And they also have to be well capitalized at the bank holding company level. And this is a newer requirement from the Dodd-Frank Act. They also must have a CRA rating of satisfactory or above. And if they meet these criteria, they then are required to file an election. And typically any holding company that is qualified, regardless of what they intend to do, will file this election. So this is something to always keep in mind, how important it is during the examination process that the bank and the holding company get to the well-capitalized, well-managed categories if the company is a financial holding company, and particularly if they own any of the companies in their structure that would not be permitted were they not the financial holding company. So it really does sort of, I think, bring it sort of full circle, this whole sort of compliance and supervision of banks and their affiliates. So a financial holding company is permitted to engage in activities that are financial in nature or incidental to such financial activities or complementary to such financial activities. And what is to keep in mind is that some of these terms are defined in the statute and the regulation, and some of them are still open to future interpretation. So if a financial holding company has a new activity, they can apply to the Federal Reserve Board for approval of a new activity on the basis of it being financial in nature, incidental to such financial activity, or complementary. And you might remember that bank holding companies can only engage in activities so closely related to banking as to be a proper incident there too. And those were the activities where expansion was occurring prior to 1999, but now you cannot ask for any new activities under bank holding companies. They're all to occur in financial holding companies. The key provisions of what it means to be financial in nature are in the statute. And here I've written out some of the key provisions that occur in the statute and highlighted the two that we're talking about in this module, as well as really the two that are the most significant. And it's the insurance agent or underwriting and the underwriting of securities. And one of the interesting things is that, as I said, this incidental to financial activity is where the expansion is permitted, but we've seen not nearly as much as was expected. Really what we're seeing the expansion is the delivery methods, the technology and the apps, as opposed to completely new activities that are requiring approval. But it still is there, and something, sort of to keep in mind if you're working at a bank or a bank affiliate and you're thinking of engaging in new activities. So I had just mentioned what the bank holding companies can do, and it is worth also remembering that the bank itself still only has those incidental powers that are necessary to carry on the business of banking. And so, every company in the bank holding company structure has a limitation. And just as I like to put up a picture again, the financial holding company or the bank holding company is at the top. It can then have a bank, non-bank affiliates, and then subsidiaries under the bank, or there could even be other subsidiaries under the affiliates. But all of these companies, because there is a bank in the mix, are under the Federal Reserve Board's authority, and they are subject to restrictions on their activities, as well as many of the other restrictions we've talked about. Now, you might recall that it's possible to have a non-bank bank, and then you wouldn't be under this structure. But those are really only the smaller institutions. So with this expansion into these new areas that were previously not permitted until Gramm-Leach-Bliley, there was a discussion about how to regulate the new activities. Who would regulate? And because, again, it's a result of compromise, it was decided to go with this concept of functional regulation. And what that means is that whatever the activity is, the entity that traditionally regulates that activity would continue to regulate it, because there was concern at the time. The insurance arms didn't want bank regulators looking at them, and the security arm didn't want bank regulators looking at them. Everyone just wanted to keep their same regulator. It's who they're familiar with. And so, like all laws, it was a compromise, and it was sort of this silo of regulation and supervision. Well, what we found in 2008 is that that can be a problem. Things can get out of hand if no one is looking over the big picture. And so we now have the concept, in addition to functional regulation, which does continue, as we also have umbrella oversight, and that's the Federal Reserve Board. So the Federal Reserve Board now has the ability by statute to really look at any company under the holding company structure. But in general, the functional regulation is where you still get the detailed kind of regulation, examination, and supervision. And so we did read a little bit about the SEC and the security broker dealer push-out provisions. And so previously, there was just a blanket exemption for bank employees. Bank employees didn't engage in a lot of selling of securities, but they were not required to be licensed as dealers under the SEC regulations. And that was removed with the whole concept of GLB and these larger companies. And so the result being that most banks do not allow their employees to be brokers, because they don't want bank employees to register with the SEC, because the SEC requires capital and financial reporting that differs from the way financial reporting is required for banks. And that is actually part of the idea of functional regulation, is that insurance regulators, the SEC, and the bank regulators each have their own way of judging capital and wanting things reported to them. And so it's very difficult if a single entity has to prepare different kinds of financial records. Now, there are certain limited activities that bank employees can engage in, but typically they are sort of conveniences merely to a bank customer, and they may get some kind of a nominal pay or a referral, but nothing that's sort of a contingent fee or that's any kind of significant fee. And so because of this new regulatory scheme, we really see banks not allowing their employees to engage in securities brokering, and putting that in, making sure that individuals engaging in those activities are employed by an affiliate of the bank. And so, as you can imagine, this was initially fairly disruptive. Employees had to sort of decide what they were going to focus on, and then consequently where they wanted to work. Now, the other kind of big concern that we see, and something to keep in mind, is that the broker piece, both on insurance and securities, is a selling piece. You're not putting together insurance, you're not putting together securities, you're selling things. So it is a limited activity. The underwriting is where the true risk lies. And consequently, banks are not permitted to engage in underwriting, other than, as it says here, certain government securities that are expressly permitted by statute. And so any type of securities underwriting business must occur in a separate company that is kind of a side-by-side affiliate or subsidiary of the bank. And when we have these kinds of activities occurring in affiliates, we start to have concerns with customer confusion, and particularly the biggest concern is customer misunderstanding the scope of FDIC insurance. And that was the subject of the case we read in the matter of Nations Securities and Nations Bank. And this was an actual SEC action. And so if you look at these names, they're really quite similar. Nations Bank, Nations Securities. And this involved the sale of these bond funds, these term trusts. And these brokers that were with Nations Security were calling customers of Nations Bank And they were oftentimes, because in the 90s, it was oftentimes things were actually done in person. So they were actually sometimes even inside an actual nation's bank. And they were acting as investment advisors. And what was discovered in the course of an SEC sort of examination was that they were expressly soliciting customers of the bank who had been purchasing CDs. CDs are FDIC insured, and they're very, very secure for that reason. And it was decided that they were really preying on people on their lack of understanding and on the similarity in their names. And it apparently was a very, very heavy sales tactic. We have some quotes here, and there's more in the case. And so consequently, this is exactly what the regulators are concerned with, that these individuals would blur the line between what's FDIC insured and what is an investment product. And in this case, it was clear that these weren't individual sort of rogue employees. This was actually endorsed by management, and it was a sort of a plan that was developed at a higher level and then sort of put down to the salespeople. And so this is sort of the opposite of what a good compliance program would do, because instead of making it very clear the risk involved and that this is not an FDIC insured product, there was actually, I guess, an actual goal to make the customer unaware of that. And so consequently, there was a fine, which was hefty in the 90s, and the practices were ceased. But this continues to be a big area of examination and supervision. So anytime you have an affiliate of a bank, it's very important that all the printed material and the marketing, as well as the training and sort of the conversations, if there are conversations today, make it clear when you have an investment product and when you have an FDIC insured product, particularly if it's the same website, the same office. And in a sense, it can be a benefit to having things all done online, because on these face-to-face conversations, it can be much more challenging from a compliance management standpoint to sort of make sure people are saying the right thing and not giving the wrong impression, and particularly, and hopefully this would never be the case, if there's any kind of financial benefit to the employee to sell a particular product. And so this does sort of bring us back to sort of something we started off with on this semester is, how do you have a good compliance program, and how do you prevent sort of the kind of thing that we see in this case? And it is supervision of employees, written compliance programs, employee training, monitoring, as well as auditing, and always a good idea to include a legal review and to get the lawyers involved at some point with looking at the compliance program and the training in particular. And so we are at a place now where, in general, banks can engage in brokering, they can engage in selling, although as a practical matter, the bank itself will not engage in selling, although it's not prohibited, but they then must have their employees register with the SEC. So it's kind of a self-imposed prohibition. But in either a financial holding company or a bank holding company or a financial subsidiary, the selling is permitted. But the underwriting is not permitted in the bank ever, and it's not permitted within any bank holding company structure unless the holding company has elected to become a financial holding company. And it would then also be permitted in a financial subsidiary. So we can see this is a huge benefit from Brown-Leach-Bliley to the extent these holding companies wanted to get involved in investment banking. And if you look around, you'll quickly see that that's really the big area that the banks and the investment companies have come together and been very successful. The other piece, which interestingly was the more controversial piece, has not been as successful, and consequently we don't see it as much. But in the insurance side, we also have the agent and the underwriting, although we don't think of it as underwriting, but putting an insurance policy together is essentially insurance underwriting. And the agent piece has always been permitted by banks national banks and consequently typically state chartered banks as well in small towns, but not in larger towns. And that's based on the section 92. And as we know, if you decide as a bank to have your employees act as agents, they do have to be licensed and comply with all state registration requirements. And this can be fairly onerous because if you do it in multiple states, every state has its own insurance department. And so you'd have to get licensed in multiple states, and there can be different requirements for the insurance policy. So this is really something that, that's a state by state compliance scheme, which, as we've discussed, is onerous, but it also is something that the insurance industry sort of sees as their asset, because if you know all these state laws and you have all these connections, it is a real asset and something that they were worried about losing. And although there is a 50-state, licensing scheme, after Gramm-Leach-Bliley, there was a requirement that there be certain uniform parts of the application. So it has made it easier to get the multi-state license. But we just haven't really seen nearly as much expansion by the financial holding companies into insurance. But as we read about, there's sort of a complex, or a more complex, I would say, scheme on the insurance side than on the security side. With the brokerage in the bank, it is allowed in small towns. And then, as you read, it's also allowed if it's credit insurance. Credit insurance was determined quite a while ago to be part of the business of banking. And by contrast, in the context of Gramm-Leach-Bliley, it was determined that banks should never sell title insurance. It was determined to be a conflict of interest. So yes, in small towns for brokerage, yes for credit insurance, but no for title insurance. And then yes, in the financial holding company and the financial subsidiary. As for the underwriting, we see that it's no for the bank and of course no for title insurance, but a bank itself can actually underwrite credit insurance, again, because it was determined quite some time ago to be part of the business of banking. And here where we see another difference is that the financial holding company or a side-by-side affiliate can engage in insurance underwriting, but a company, a financial subsidiary under a bank cannot. And again, some of these are just the result of compromise, but it is a somewhat complex scheme and more complex on the insurance side. And maybe that's another reason that the banks have been more leery about getting sort of into that under their holding company structure. But I did ask you to look at a question that kind of talked about sort of the advertising and what can be done to make it clear. I mean, I don't know. To me, I'm never quite clear why one would think that FDIC insurance would apply to insurance or to investments, but not everyone, I guess, is a banking attorney, and so that whole review of any type of advertising that comes out, particularly if there's any hint that a non-bank product is a bank product, is something that's really a very key compliance point for bank regulators. And so we've seen a fair number of actions on that front. So this really completes sort of the topics that we're discussing here in financial compliance. I do think this review of sort of securities and insurance activities brings together some of the different concepts that we've discussed throughout the semester. And if there are any questions, please feel free to reach out to me. Thank you.